Hey everyone, hope you're doing well today. This is Drew Creekmer, and I'm joined today by John Creekmer. And we're going to talk about kind of what's going on in the world and in the markets and walk through how it applies to your investments and overall financial planning and how you achieve your goals. But before we do that, John, how you doing? You snowed in, or did you get through your driveway or no?
Yeah, I tell you what, we got plowed out by the farmer a little bit last night, and then this morning I was up there early shoveling and trying to get stuff out. So able to make it out. I'm actually in the office today, which is a good thing. So it's great to be here, and this might hopefully be the last snowstorm of the year for us here in Illinois. We'll see how it goes, though.
Yeah. Hopefully it's the last big one, and spring's just around the corner, right?
Right, for sure, for sure.
Yeah. So hey, you mentioned the office, and for anyone who's listening to this, hopefully you don't hear any banging. John, do we have what do we have going on in the office in Morton right now?
Yeah, so I'll tell you what, our current we're all in temporary locations, still on the same on the third floor, and kind of spread all around. But we actually this week on Tuesday started and today's Friday, so we started off gutting the entire existing office, and so it's pretty much gone. It's down to the studs. The carpet's getting yanked out right now, so we're in the midst of actually rebuilding out the entire office, and it'll double the size of our availability as far as having new people there, as far as on both support and also advisors and research people, technicians, tax people. So it gives us more capacity to serve people in a more robust way. So, but you may hear banging in the background because they're just right next door to me. So.
Awesome. That's exciting stuff. So looking forward to getting that done. ETA on completion. I know that's always iffy.
Yeah,
6 to 8 weeks. Is that fair?
so we're shooting for May 1st, and so we'll see how close we get to that. But we're kind of hopeful that we'll be somewhere around that first part of May.
Okay. Awesome. Awesome. Well, hey, let's dive into it. And, today we're going to talk about something. I think it was one of the first things actually that you had me start doing research on when I started now close to a decade ago. And that's something called a Black Swan event. And it's kind of a funny name. But, John, what is a Black Swan event and why is it so important? And right now, especially, why is this a phrase that people may be hearing more about?
Yeah, so when you think of swans, normally think about a white bird, right? And I know back in goodness, 21 years ago now, I was over in Bruges, which is over outside of Belgium, and I was there visiting family, and we were sitting on one of the canals, and my dad was sitting there. We were having some pastries, and he goes, "What do you notice about the birds there?" And I said, "Oh, that swan is black. That is really weird. I'd never seen a black swan before. I've seen lots of white swans." But a black swan is so unusual. It happens so very rarely. It's whenever you see it, it's really a little startling to see the black swan swimming in the canal. Well, black swan event is something that happens out of the ordinary, and it happens every now and then. And there are things that really you don't plan on, you cannot forecast, but they're impactful as far as on the impact. However, as with most things, black swan events don't happen, they don't last forever. Their impact is usually over a short period of time. It's usually something that happens that the impact is kind of large, quite honestly. And
Right.
sometimes it's not, but something unusual that happens. And right now, Drew, there's a whole bunch of different black swan events in history, and we could probably talk about some of those to kind of give people some perspective, also.
Yeah. Well, you mentioned 21 years ago. And I mean, I think it's kind of a really formative event, but 9/11 was, from a stock market standpoint, that was a black swan event, right? There was a definite effect there. And we have things like the first Gulf War, the Iranian hostage crisis back in the late 70s. Those were all massively impactful, both political and just global events that led to some pretty serious things occurring. But from an investing standpoint, we had a quick reaction from the stock market in a negative way. There's a lot of volatility and selling off.
Mhm.
But of course, when you zoom out, which is really, really hard to do in the midst of some of those things that are going on that are pretty concerning, it's a long-term buying opportunity as an investor. And so this chart that we have up here, it's really good to see both the short term, some of the volatility that's going on in the market around these events, but able to see, however, the long term, it's a really great investment opportunity, even in the midst of some really tough stuff going on. And so, John, right now, what are the black swan events that are maybe occurring or being talked about and that we're tracking pretty closely?
Yes, I mean, obviously, the last 2 years we've had the big one in front of us, which has been COVID, a worldwide pandemic, and it seems to be kind of getting to the end of that, going ahead and being classified more as an endemic state right now, which simply means that the contagion, the how contagious the virus is going down, and also the impact
Right.
severity is going down. But But outside of that, we do see inflation running at a very high clip, 7.5%. So that's something which is kind of on the tail side of all of the stimulus that all the federal governments all around the world did. But then also as far as things that we're seeing with Russia and China and even to a certain extent North Korea. And so I would say that as far as, we don't get political and things that we talk about, but there are things that happen on the political side of things that definitely impacts. And so with the U.S. withdrawal from Afghanistan, a lot of world leaders that look for any opportunity to try to see what they can get away with and what they can do, how far they can push the envelope. They saw that process that America went through as an opportunity to try to actually extend a little bit some of the things they were doing. So right now we see Russia up on the border of Ukraine, and the big question and debate is, are they going to invade? Will there be a war? Or is it simply a move as far as on the chessboard for them to negotiate some better terms and not have NATO allow Ukraine to come into NATO? And Russia actually does not want that because that would put Western forces right on their border. And also, we know that Ukraine is a very strategic country for natural resources and then also for pipeline for oil. But we also have things that are happening over in China with Taiwan. And so whenever we see that wars and rumors of wars and we have things like that, those are events that can have a short-term impact. The question is, what is the severity of the impact and how long does it last?
Right. Right. And it definitely seems like there is some negotiation that's occurring. I know I just saw today that Secretary of State Blinken supposedly is going to be over in Russia next week negotiating. So we'll see what comes of that. And John, I think it's really tough when we see the headlines, and they're pretty concerning, obviously, and we see the market going down, to have perspective and to not allow emotion to rule the day and rule the decisions that we're making with our investments. How do we combat that? How do we, look at the event for what it is and analyze it, but separate maybe the negative of the event from making a poor investment decision?
Yep. It's one of these things that I've been working in the financial world since 1991. So here in June, it'll be 31 years. And so you guys think back to that chart that was up a second ago. That was a 50-year chart. And so 60% of that entire chart period, I have been working in the money world. So I've endured a lot of different black swan events. And I've seen people make good decisions and a lot of people make poor decisions in that time. And you need to go back to what is your principles. And so number one, what you need to do is you need to say, what is the length of time that I have before I need to access these dollars? And if you're already receiving income from your investments, you need to make sure that we have communication, strong communication, that talks about how it is the income that we're sending to you on a monthly or a semi-annual or an annual basis. How are those dollars invested differently than our long-term money? So the first thing is to make sure you have proper alignment of length of time as far as when you're going to need the funds. The second thing that you need to do is you need to recognize that we need to make investment decisions that are based upon logic and not based upon emotion. I've been doing a lot of reading lately from different psychological authors, and that kind of going through more of behavioral elements of investing or behavioral elements of life. And it's interesting, one study that had a whole group of people go through a whole list of questions to measure their positive thoughts and their negative thoughts. Then they had them watch 3 minutes of the nightly news and then take the exact same list of questions. The negative response after watching 3 minutes of the nightly news, the percentage of negative response was actually 27% higher. And so whenever we watch the news, and anymore the news is not really created to give us information, it is created to stoke emotions. And so based upon that, that leads us then to have an emotional response based upon what we are hearing. And that emotional response oftentimes is the wrong response. And so we need to look for opportunities in the midst of anything happening in the world. And it's interesting whenever we get our statements and maybe they're down for a month. I know January is a tough month for a lot of reasons. So we had the scare of inflation. We have just thoughts as far as with different political bodies all around the world that are doing different things. And so within that, there's opportunities, though, to reset portfolios, both for protection and for long-term growth, and look for opportunities which that could, quite honestly, could be a generational opportunity in the midst of all the things that are going on. So number one is to make sure you properly align your timing of when you're going to touch the money, when you're going to need to access the money with your investments. And number two, to make sure you make investment decisions based upon logic, not stoked as far as some emotion. Those are the two
Right.
biggies, Drew.
Right. And so let's now go granular and actually apply it to what we're doing, right? So that's the framework that we're thinking from when we're making investment decisions. We are trying to use logic, cutting through the noise, because logically there are some things that we feel are very good moves to make. I think one of them, John, we talked about it, I think a couple of weeks ago, was the impact that rising interest rates, which is being done to combat inflation, the impact that has on bonds. And so one of the things that we've done is decrease fixed income exposure, and we've been using these target outcome ETFs. And can you just real quickly summarize why we're doing that for folks?
Yeah. So the target outcome right now, interest rates, they're very low as far as historical terms, but we are seeing them start to increase. So the 10-year Treasury, as an example, has more than doubled the interest rate paying on a 10-year Treasury over the last 13 months. Whenever you see that rapid of an increase, well, then that has a negative return impact as far as on your bond funds. Whenever you have, and folks would have bond funds to be more conservative or to basically hedge versus the stock market. And so right now, though, that's basically you're looking to break even over the next 12 months, if not say we're going to lose 3 to 5% no matter what inside bond portfolios. So with a hedging strategy, we are actually using what's called a target outcome ETF, in which we have a couple of different options inside of that ETF. And with that, then it is saying that if we have a buffer on the downside, so with one of them, the most we can lose over the course of 12 months. The first 10% the market is down, you're totally protected. And the second one is what's called a deep buffer, in which the first 30% that the market is down over 12 months, the most you'll lose is 5%. And the question is, why is the buffer set at 30%? Well, the reason why I had a meeting, a lunch with a fellow that is actually running the strategy for us, and I asked him that question, why 30%? That's interesting as far as on the buffer. And the reason being is that he said there's never been a period of time in the history of the United States in which the stock market has dropped by 30% that the federal government did not come in and infuse the market with liquidity. It's, in other words, they're providing a bit of a backdrop there. Whether they should or not, that's a whole different point of discussion, maybe for a different video. However, we see that. So that provides downside protection if the market goes down. It also allows us to have some stock market performance on the upside. So there is a cap on the deep buffer, somewhere between 7.5% and 9.5%. If the market does 20% in that period of time, we would simply liquidate the buffer and have a return a little bit higher than what the market says. So it's a way for us to hedge or limit the downside exposure. Now, our buffers, for the most part, are coming due every month. And so they have a maturity every month. So the further that we are away from that maturity date, on your statement, it may show a little more volatility, but the closer we get to that 12-month, then that loss actually decreases and decreases until we get to the actual full buffer amount. And so it's a way for us to protect money inside the account.
Right. And it's a pretty sophisticated way to reduce risk in portfolios that's typically been reserved for insurance companies, large pension funds, et cetera. And it's actually a newer tool that we're able to bring into our portfolios. But it's a really timely tool as we are seeing rising interest rates really provide a negative impact on bonds. So we're really glad that we're able to have that in our portfolios and provide better upside with a really solid downside protection. So that's a great tool. The other thing that we're doing, John, is we've made some adjustments in the equity portion of accounts, so in the stock portion of accounts. And we are moving towards high quality businesses that have sometimes been classified as value stocks or value companies. And can you talk through why we're doing that at this point in time? And then really we've been doing over the last probably 2 to 3 months, we've been making that transition.
Yeah, so when we're making a change, so the economic cycle or the market cycle actually presents opportunities for different types of companies to do better. And so whenever we look at an interest rate environment that is an increasing interest rate environment, if you are in the growth phase of your business, you don't have a whole bunch of extra cash reserves just sitting in the bank that you can tap to expand your business. And so a lot of companies that are really growth based, whether it be younger as far as in size or in an industry which is rapidly developing, either way, well, then they're actually borrowing money either on the short term with a variable interest rate, or they're borrowing long term where those interest rates can reset. So if we're in an environment whenever we see interest rates going up, the cost of them doing business also goes up. And so because of that, those type of companies actually underperform. But whenever we look at what's called a value stock or a high dividend paying stock, in most cases, they're in more mature industries. They have a little bit more pricing flexibility in which they can actually increase prices with inflation. What they can also do, though, is they have a large amount of cash in the bank, and so they're not borrowing money, as much money for their operations. And so because of that, their cost of doing business is actually going down. And so because they have the ability as far as on pricing to increase, more elastic is what it's called, so they have price elasticity to increase the prices that they're charging people. But then also as far as on their borrowing costs, it will not be going up because they're not borrowing as much money. So due to that, with looking for companies with low debt ratios and also higher cash balances or short-term assets, well then those are companies that we like to call aristocrats. So they're the best of the best, they're very solid. Now they're not going to have the same long-term growth potential as some of the high growth names out there in the past that we've lived and all reaped huge benefits in our portfolios from. However, in this season, it is either both safer and also more responsible way as far as investing money.
Right. And, I think kind of the last thing that we want to hit on is just the value. You mentioned it earlier that during periods of black swan events or big economic events, there's great buying opportunities. Or, there's generational companies that are founded. One that comes to mind is Airbnb for me, was founded in 2008 during the depths of the financial crisis. And typically, periods of volatility, if you navigate it logically and remove the emotion, like we've been doing here by moving to those more lower volatility areas of the stock market, you're going to be able to purchase some really great companies that have just been beaten up because they're those higher growth names. And so, John, from your standpoint, what is the value of an active manager in this environment?
Yeah, so the value is number one is to remove a lot of the emotion from the equation. And so that is the first one. We know that a lot of mistakes are made in portfolios through behavioral, emotional decisions. So the first one is it is all logic based, and we're removing the emotion away from the equation. So secondly, would be that we're always looking for the opportunities within the economic cycle to say what are the best opportunities with the lowest level of risk for us to have the highest level of rate of return for the period of time that we're looking to track. So if we're having money used for retirement, or they're for our Roth IRAs or IRAs, or else they're just long-term non-qualified dollars, then what happens is we have the ability to say, we have some tremendous opportunities with some companies that have gotten beat up over the months of December, January, and even the first part of February, that are phenomenal companies with tremendous, not only track records of growth, but future projections of growth based upon the industries that they are in. And so we have the ability to identify those and place those into our long-term growth sleeves. The manager, though, also has the professional benefit of being able to say, but we also want to, not just taking risk, we also want to be able to manage the level of risk that we have in the portfolios by bringing to market and bringing into portfolios very sophisticated tools that provide the protection that we need with also the growth. So it's really that threefold purpose of having the professional manager there is remove emotion based upon logic, look for opportunities that are presented, but then also making sure we have proper level of hedge or protection in the accounts so that we're more prepared not just to withstand, but to be available for the second wave of opportunities whenever they present themselves.
Awesome. Thanks for clarifying that. And we're bumping up against our time here, so we won't dive too far into it. But we made a video talking about a new fund that we're bringing to market that allows us to work more in people's 401ks, 403bs, their retirement plans. It's a really specialized product. It's one of the biggest things I think you said in our video that we made that people have requested over the years. So in 30 seconds, can you wrap up for us, summarize, and encourage folks to watch that video if they have time?
I'll tell you what, it's the largest financial asset most people have is their retirement plan at work. And yet one of the biggest obstacles of that retirement plan is how do I invest the money in there? And one of the biggest questions we get, the number one question we have from all of our clients that are currently working is, can you help me make the investment selection in my 401k? Well, we can, but that's usually a one-off in that moment. And so it's not really something which is being actively managed. It's not dynamic. And so we have actually brought to market a fund in which we manage that fund, that if you happen to have a workplace retirement plan, and we're seeing a growing number of companies, lots of companies that offer a self-directed brokerage account, we can now actively manage your 401k, 403b, 529, whatever it may be, 457 plan at work. We can manage that for you as far as with using our new fund that we have available.
Yeah, and so definitely watch that video, and then at the end of it, we'll have a place where you can say, "Hey, give me a call. I want to talk about if this is a fit for me or not, based upon my goals and what my plan offers." And so definitely watch that video. John, we are up at our time. I think we covered some great information here. Send us off with just something to keep in mind for the rest of the week.
Hey guys, end of the week, make sure you enjoy things as far as with family. I also want to encourage you, turn off the news. There's so many negative things there. Go outside, enjoy the weather, enjoy family, enjoy friends that you're around, and let's all turn off the noise and focus on the things that are most important to us.
Yeah. Awesome. Awesome. Love that. All right, guys, thanks for the time. Hope you found this helpful. If you have any questions, by all means, shoot us an email or give us a call, and we'd love to chat with you. Thanks. Have a good weekend.